side meetings going on here in terms of potential investment, like I've seen several already. But tell us, if you could, what in general are investors looking for out of potential investments, especially in the technology space? Just a good general question on that.
I'm a little different than most people. For us and our team, I look for people that are completely opposite of me. I'm completely disorganized. I leave kind of this trail of stuff behind me wherever I go, and I'm always thinking about the fifth thing when I'm talking about one thing. So I like people to be extremely well organized, well thought out, and then certainly they have to have a lot of passion. But to me, that number one thing is organization, really.
You know, I think what we look at the end of the day, we're investing in the founder. You know, we want to be able to rely on and trust the founder. We want to, as Jeremy said, make sure they're organized, they have the governance in place, they have the financials in place, and really, you know, that they're a master of whatever industry or market they're trying to penetrate. They have to totally understand that either them and their team combined have a full grasp of the market.
So I'm curious, we often see that entrepreneurs will tell us, well, I'm not quite ready to talk to investors, or for that matter, ready to talk to folks in the market. Where would you place in the balance between kind of waiting until they're perfect or waiting until they're really ready versus early? Where do you think in that scale they should start talking to investors, and for that matter, even talking to potential customers and folks like that?
With us personally, right away, you know, in the growth of our company and with the folks that we talk to, I think it takes a long time to make those impressions and to be able to speak to what people want to hear. And everybody wants to hear something different. And I know for us, when we initially looked for investment, I had no idea how to tell people what they wanted to hear. I just told them what I wanted to say, and needless to say, we never got any money. It just didn't work out real well. So I think it's better to start early, because you're practicing that just like you practice everything else. If you wait till you have something perfect, by then it's too late anyway. At that point, you really don't need investment. So I would say start as early as you can and just get used to the process and get used to the people.
Yeah, I would say, a pitch to Innovate, if you're doing kind of a soft pitch or trial, type run, so to speak, that's a good place to learn, and you may not have to have all your ducks in a row. In my experience, when you're going out to, bona fide investors to try to raise money, you really need to have the governance issues in check, the financials, you kind of have to have your ducks in a row. And but Innovate provides a really good kind of training ground, if you will, in a lot of the entrepreneurial schools. But when you go out to pitch for quote real money, I feel like you need to have it all pretty tight.
So, by the way, we're going to take questions from the audience. Matter of fact, we can go ahead and if anyone has questions, we'll jump in. I did want to mention while you're thinking of those, so from just from Innovate Mississippi's perspective, no company's ever too early for us. I am surprised how many people are like, oh yeah, I'm going to come see you in a year. And honestly, we'd rather catch people when they are literally at the idea stage, the earliest stage possible. So from an Innovate engagement, I will just throw that out there. We really like to engage from the earliest stage possible. And it's sad sometimes when I hear folks waited a year or two before engaging with us, because we'd rather engage as early as possible. I do want to open up for questions from the audience, because we'd like to get questions from the audience as well. Any questions so far? Come on, don't be shy. Yes, Terrence.
This is a question for Jeremy. 33,000%. How'd you manage that?
I didn't. It was a complete disaster. So, and it still is a complete disaster. And I think that talks to your initial point of when you start looking for that help. It's just a disaster. It's a disaster every day. I have no idea what we did last quarter, but I know in the first quarter of this year it was about 800%. The second quarter it was 300% growth. there is no way to manage that. It's impossible to manage that type of growth whatsoever. And so our hiring practices weren't based on really people's skill set. It was based more on, and still is today, on do we trust those people and do they work hard? And those are the two really foundations of those people that we bring onto our team. And it's the same thing that I look for, in an investment when I'm looking at, someone that's organized. I'm going to go ahead and trust somebody that's organized because they obviously know more than I do. They can write stuff down and they know where and when to be, et cetera, et cetera. And so, it's a process and it's a learning process. We've made a lot of mistakes along the way in every aspect, but I mean, that's what being an entrepreneur is. If you're waiting till you're perfect before you do something, you're never going to do anything. I make hundreds of mistakes a day, and I think, everybody in this room that has done any type of entrepreneurship, I mean, that's what you do. You make mistakes, but I wouldn't say there's a difference between 33,000% growth and 100% growth. It's still growth. It's still new suppliers. It's still new financing, new team members. It's just an exacerbated problem, but it's a problem nonetheless.
All right, please don't be shy about raising your hands. We're going to continue with other questions here as well. So to that point, I'd be curious if there was just one thing that you see as a common problem entrepreneurs are facing, or even investors as they're working in these deals. Is there a common theme that you could pull out to say avoid this, or here's something that I see that we wish folks wouldn't do?
You want to go first on that one?
Well, I was going to say, Jeremy, you said it was a disaster, but the one thing he does know is the numbers, right? So the numbers matter. He can quote the growth percentages. So, of course, I'm a numbers guy, but at the end of the day, it does all boil down to the numbers, to the financials. As far as, one thing, I don't know that I see a common mistake or thing that's left out. I think there's a tendency to forecast, a lot of times, really growth is just out of the roof, and of course there are examples of cases where that does happen, but sometimes I can turn an investor off if the numbers just seem a little bit too pie in the sky, in my experience. So I think, being able to generate reasonable numbers and be able to back them up, is certainly important.
I like numbers too. That's half the time I'm yelling at my team. It's give me better numbers. I think, I think one, there's too many people that are scared to fail. And I think that's a lot of it. I kind of put it in like the summation of, I'm sure everybody in this room at one point or another has thought about writing a book, right? It's just things that people think they're so important. They're going to write a book and everybody's going to read it, et cetera, et cetera. But hey, where do I start? Where do I do this? How do I begin? And I think that's really the second guessing is important, but it can't stop the action. And if every time I second guessed myself along the way, I stopped, that nothing would ever get done. So I think that's the important thing is you're going to be wrong. You're going to make some mistakes. Just don't be afraid to make the mistakes, because this is the wrong world to be in if you're afraid of making mistakes.
So we're going to talk at the second investor panel today is going to be about angel investor funds. So they're going to be talking a little bit more of kind of the structure of some of those pieces. But I'm particularly interested, Michael, from an accounting perspective, how, before people get to a handshake, how much of a deal do you think needs to be done? Like, are you seeing, agree on the percentage only of ownership and let's just shake on that, or are you going 3-page term sheets before people are shaking hands? What do you think is the level of detail that you should be before you feel comfortable that a deal is going to be consummated in terms of that handshake? What level of detail are you seeing, or is it just sort of a very high level?
Good question. I I've always been of the mind that the more detail, the better, and I think a lot of the investors I work with are the same mindset, because as most of you guys know, it takes a long time to raise money, and the process is a long process, and so the more you can hammer out those details through a term sheet is great. But the more you can hammer out those details on the front end, I think it just saves time on the back end. So that's kind of my thought on it.
So I know another question we often get, how many no's should an entrepreneur expect before they get to a yes? And what do you think are the key elements out of a no, I guess, before they can finally get to some of those yeses?
A lot of no's. For us in particular, I still probably hear 20 no's before I hear a yes on anything that we do. I think the important thing is to ask why when you hear no, and not necessarily to change everything, but to take that advice. I mean, if I talk to someone and have many times and said, hey, here's the plan, and they are like, there's no way we would do this, well, why not? Well, because of this and because of that and because of that, using that to learn and to grow the next time, there's less no's in the next conversation, and there's less no's in the next conversation. And how many no's to expect? I mean, I was sitting back here in a couple presentations ago, and somebody said no to me about something we were talking about, and it just happens. So the biggest thing is to learn from the no's as opposed to being discouraged from the no's.
Yeah, well, that's good information, and Jeremy, certainly you've dealt with that a lot more than I have. But there are a lot of no's. I think a good rule of thumb is it takes twice as long to go through the fundraising process as you normally think or people expect. So that's been my experience.
All right, so folks in the audience, entrepreneurs, we've got some investors up here. We have a chance to ask them questions in front of everybody, where they have to give an answer. Any other questions from the audience? Don't be shy. Yes.
When valuing the company, what are some of the key performance indicators you guys look at?
You're going to spend a lot longer talking about this than me as an accountant, but every time. When you value a company, at least from our perspective, I value it based on the person, because any new company that doesn't have a product, and they say, oh, it's a $500 million market share or a $10 million market share, and we're going to get 10% of it. There's still no value. If it gets to the point where they have some gross and some net earnings, certainly you can value, based on that, at least with all else held constant. But I solely look at the people that are running it, because that's where the real value is. And maybe there's some value in the numbers, but at that point, most of the time it's beyond investment. It really is by the time you're looking at numbers saying, oh, that company's probably worth $20 million or $10 million. Well, okay, that's great, but that means they're already making money, so now they need some management, etc. That's going to come down to who's running that company, because what decisions is that person going to make? Are they going to sit down and say, hey, we're a $10 million company and we never want to get bigger? Then why would you ever, invest in that company? Is that person someone that says, hey, I'm going to put everything back into the company and grow it? So again, it all comes back to who that person is. And we've looked at a lot of acquisitions, and sometimes these people have, fantastic ideas. And then, someone on my team goes, yeah, we just don't like that person. Or sometimes we look at teams that they don't even have a product yet, but they're really good people. And that's where the money is going. And that's just from our perspective. The company really has nothing to do with it. It's the person, because the person ends up being the company.
Yeah, I couldn't agree more. It's really impossible to value a true startup company from using any kind of reasonable metric. So at the end of the day, you're investing in the founder. The one thing that excuse me, that we look at is what I call the multiplier effect. A lot of people call it the network effect okay, stealing from our friend Vince Jordan, build it once, sell it many times over. And so that's, at the end of the day, that's really the driver of value is it's not like an accounting firm where we, to make more money, we have to spend more time, per se. We're looking at the multiplier effect of, how many times, how can we scale it, and that's really what you're looking for, in my opinion, and that's where you're gonna get the huge returns, so.
All right, yes, another audience.
As an investor, is there anything about someone partnering with the university, what a business partnering with the university for a business that scares you about that?
A lot. For us individually, when we started to get going, we had a lot of universities that wanted to do some work for us. There were a lot of universities that we wanted to do work for us, et cetera, and back and forth. And we thought, well, these are the foremost people in the world in certain realms that could really bring some expertise. And when everything boiled down, it really comes down to that non-disclosure and that non-compete. A lot of universities want to retain a portion of that information. Now, we were able to recently actually sign a non-disclosure and a non-compete with the university where they literally we're just going to work together. But I think that's the hardest part to get through. It's not necessarily not to partner with the university, but it's really, really difficult if some of the technology has come from the university or people working at the university have come up with some of the stuff, or they make good contributions to it. I mean, that's how universities get their funding, right? So it's that balance of how do you work with that university, how do you make that partnership, but still be able to retain, one, your rights as a company, and two, give the university its due. I mean, if they're bringing something to the table, they need something in return as well. So
If you pass that hurdle and you're in a good place with that piece, as someone that would be investing, is there anything that would scare you about?
nothing at all.